Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Welcome to Many Happy Returns, where we aim to make you a better investor. I'm Romin.
And I'm Michael.
Which assets made the naughty list this year? Some of 2025's most confident calls turned into cautionary tales, from momentum trades that stalled to consensus positions that backfired.
We explore what went wrong and what these setbacks might signal for the year ahead. And in today's dumb question of the week, is any asset immune to interest rates? All right, let's get into it. So, Romin, it's that time of year when we need to think of Christmas tie-in episodes, and we've got a good one. It actually came from your partner, Laura, didn't it? The naughty list.
And as a dad, this is one you'll appreciate, Michael.
Yeah, my kids are flittering between the naughty and nice list day by day, I would say. I do warn them, like, Santa can change his mind right up until the 25th. But in terms of assets, it's been a good year, right? People think of it's a good year, stock market's up broadly. But amongst all that, of course, some things have made it onto the naughty list. Not everything rallies at the same time. And you just better hope your portfolio wasn't overexposed to this stuff. I'm sure Santa's wasn't. You know, he's making a list, he's checking it twice. That's due diligence. That's what Santa does.
I think the biggest shock for me was the dollar over this last year. And as an index investor, a global index investor, obviously that affects my return because most of what I own, if it's a global equity index, is going to be dollar denominated, 65%. So that means that when the dollar's weak, it's going to reduce my overall return, even if the US market did well. So for me, this has been a disappointment. And there are lots of reasons behind it. And it's definitely on the naughty step for me.
How bad has it been for the dollar, though? Can you sort of contextualize it for us?
Now, the measure that people usually look at is the DXY, the US dollar index, which is based on trade-weighted currency movements. Now, that's down about 10% over the course of the year. Now, that hasn't been a steady fall. If you look at what happened over the course of the year, the big fall was during the early part of the year, and it's pretty much stabilized since the summer.
Definitely a tale of two halves. Now, that's quite different to what people were expecting. After the Trump election, people were talking about the Trump trade, a pillar of which was dollar strength. And that did play out in the very short term. So at the back end of 2024, after the election, the dollar rallied strongly, but then that turned around sharply, didn't it, in January?
Now, the reason people thought that would make for a strong dollar, the Trump trade, was that if you've got things like loose fiscal policy at the same time as tight monetary policy, that would boost the dollar. However, as it's turned out, what we've seen is that actually the dollar weakened quite considerably. I think a large part of that was due to worries about what's going to happen to fiscal policy in the United States, because it looks like Trump doesn't care about the fiscal deficit. His predecessor didn't really care about the fiscal deficit. That was Biden. And if a country doesn't care about its fiscal deficit, then that does tend to weaken the currency. At the same time, we see weakening of political institutions in the United States, like central bank independence. That's a worry in the United States being eroded. The unilateral announcement of tariffs. All of that feeds into worries about whether the dollar really should remain so preeminent.
And there was a particularly worrying part of the year, back in April, May kind of time, after the tariffs were announced, where the dollar was weakening at the same time as the treasury market was selling off, which is more or less unheard of. It's returned to normality now, but that was the real scary part of the year, wasn't it? The dollar was no longer really seen as a safe haven for a month or two.
Yeah, that is absolutely shocking. And that was probably the most shocking thing for me this year. It wasn't to do with the tariffs necessarily. It was the loss of safe haven status for the US dollar. I never thought I'd see that. So it took quite a lot of political work to achieve that, but I'm not sure it was a good achievement. And I think more broadly, people were unthinkingly putting money into US assets, assuming that there'd be this American exceptionalism. And I think this has really eroded that concept of American exceptionalism. And I speak to lots of people now who are deliberately tilting their portfolio away from the US, which I hadn't seen before. And that is, I think, a worrying development for the US. It's not seen as a safe haven. It's not seen as a default place to allocate your money.
So talking about safe havens and exceptional markets, both of those apply to Japan, don't they? It's always been perceived as a safe haven. People flock to the yen when they're scared. And it's also been exceptional. It's had the lowest interest rates in the world, negative interest rates for a long time. But this brings us to the second item on the naughty list, which is Japanese government bonds. How naughty have they been?
Well, very naughty indeed, because remember what happened in the West? All of the yield curves in the West pretty much had their worst sell-off, their biggest upward shift in 2022 and 2023. As we moved out of this period of ultra-low interest rates, which had lasted pretty much since the financial crisis, into what I'd describe as a more normal regime of an upward sloping yield curve, where it's roughly at 3% at the short end, 5% at the long end, a fairly bog standard yield curve. Now, Japan had really bucked that particular trend, whereas everyone else was really hiking policy, monetary policy, coming out of COVID as they got the inflation spike. Japan wasn't doing that. So now everyone else is reducing interest rates, almost everyone, and Japan's going in the opposite direction. And that has huge effects on flows of money into Japan and out of Japan and on its yield curve. So you could argue that what we're seeing in Japan right now is normalization of the yield curve for what was an abnormal yield curve for much longer than everyone else. And that's going to be incredibly painful if the West's experience was anything to go by, because people think bonds are safe. And a lot of Japanese government bonds, JGBs, are owned by people who live in Japan, who've got their pension money in it, they've got their retirement savings in it. And seeing that kind of drawdown, particularly if they've got long duration debt, is going to be, I think, a huge shock.
Well, let's look at what's happened then. So if we take the 10-year Japanese government bond, at the start of 2025, the yield was around 1%. As of today, it's more like 2%. These don't sound like big numbers, do they? But going from 1% to 2% in terms of a 10-year bond, it's a big deal.
And if you think about how much money's parked in these bonds, it's going to be a phenomenal loss of value, because the duration of a 10-year bond is going to be, 7-8 years? And the Japanese ones will probably have lower coupon, which will extend the duration further. So we've got a multiplier of, say, 8. So 1% increase in the 10-year yield is going to result in an 8% fall in the 10-year government bond prices. And I can't even imagine how many trillions of yen are parked in these government bonds. So that could be a huge wealth destruction in terms of safe stuff in Japan.
But there's a bigger effect people are worried about as we look forward here, which is that because yields were so low in Japan, people did look abroad, like Japanese investors did go and buy foreign government bonds, foreign equity. But now, with rates rising in Japan, it no longer being exceptionally out of step with the rest of the world, maybe that money parked abroad will come home and there'll be a flood out of US treasuries, of European debt, and there might be a hunt for new buyers of that debt. This is what people fear, right? That what happens in Japan doesn't stay in Japan.
Yeah, that's absolutely right. Because if you were a Japanese investor, let's say you work for GPIF as an asset allocation team, they've got $2 trillion worth of assets. If they want to have safe assets, they park it in foreign bonds, which are giving them a better yield. They'd probably currency hedge it, and that would mean that they'd just get the currency hedged version of US dollar yields, UK gilt yields, maybe even some European government bonds. But suddenly, if domestic bonds are going to give you a better yield compared to those currency hedged foreign bonds, well, you're going to sell the foreign bonds and pull the money back home. That's going to devalue the foreign bonds, so the yields will go up, the prices will go down for gilts, US treasuries. You'll also see a devaluation of those currencies relative to yen, so the yen will strengthen. And that could be massively destabilizing because Japanese bond buyers were a huge source of demand for these foreign bonds.
Oh yeah, they really were. The number one foreign holder of US treasuries is Japanese investors. And this is also coming at a time where the Fed is stepping back, although it's found a way not to step back as much as it was going to, right, Roman?
So this is to do with liquidity. And one of the things the Fed had noticed was that we'd gone from this period where we had just stacks of reserves. Because remember that banks can park money with the central bank, and there were just huge amounts of cash sloshing around. We went from that to an environment where actually the reserves started to get depleted. Plus we've got the tax year coming up in the US, which tends to deplete those reserves. And the Fed noticed that short-term interest rates were starting to spike upwards. So what it's going to do now is buy treasuries, but it's not part of quantitative easing. It's nothing to do with monetary policy, apparently. It's just to keep reserves ample, as they describe it. So that's not easing in any way whatsoever. It is just to do with keeping rates under control.
Whatever they got to tell themselves to sleep at night, it's fine. Keep buying the bonds.
But I think I wouldn't underestimate the effect of Japanese flows. And there was another big thing, which was the carry trade, which everybody was doing, because if you could borrow in yen really cheaply, well, that was the kind of piggy bank for the rest of the world. People would borrow in yen, they'd convert it into a foreign currency, and then buy something with very low funding rates. That could even be things like Bitcoin. But if you get currency volatility, well, suddenly the cost of the hedge from yen to whatever currency you're buying stuff in becomes much more expensive. And you see very rapid unwinds of these carry trades. So again, I expect to see a lot more volatility in that space. And that would be for investors like hedge funds who do the carry trade in huge sizes. So this could even affect things like cryptocurrency, where people were using the yen as a cheap source of funding.
We're not saying that all risky assets were sort of piggybacking on Japanese monetary policy, are we?
Well, maybe not completely, but I think it definitely played a part. And I think that Japan should definitely be in the naughty corner when it comes to its bond yields. I wouldn't lay the blame at the central bank governor, Governor Ueda, but
I'm yet to see you blame any central bank governor, Robin. They seem to be your friends. Politicians always get it in the neck. And in Japan, the new prime minister has come in and decided to be quite fiscally expansionary. So there's a big fiscal stimulus going on, which I guess does put further pressure on rates to go up.
And again, we've got this tension now between the central bank's policy, which is to try and keep inflation under control, and the government's fiscal policy, which is to try and stimulate growth.
All right, enough about Japan. Let's go on to the next item on the naughty list. Oil is the third item on our naughty list, and the price of oil has fallen quite sharply this year.
Now, I think the difficulty at the moment is that people always say, well, people are going to use less oil over the longer term because we're transitioning to clean energy. I think you probably wouldn't see that in the data yet. It's going to happen eventually, I think, but it's not happening right now. The situation which we see right now is that we've got too much supply and not enough demand. So if you look at reports from the Energy Information Administration in the United States and the World Bank, both of them are talking about production exceeding consumption. And they expect that to continue through the end of this year and into next year in 2026.
Which obviously means the price of oil falls. It started the year at $75 to $80 a barrel. I'm talking about Brent crude here. And it's now more like $60 a barrel. That's a big fall. But it's been volatile along the way. And just to step back, if I said to you at the start of the year that the Russia-Ukraine war will drag on and on and on, there'll be further sanctions on Russia and pressure on its trading partners. We'll also have hot wars in the Middle East, including America bombing Iranian soil. You wouldn't have thought that's going to be a 20% fall in the oil price, would you? That's not usually what you see.
Yeah, it's shocking. I think I wouldn't have predicted that at all. I'd have said the opposite. In fact, all of the recipe is there for a spike in the price of oil, and that would negatively impact the UK, for example. So that's what I would have expected. So what is worrying is that we're seeing less demand for oil, and that generally means less economic activity. Particularly what's worrying about that is that China is a big source of demand for that energy. And if they're using less, well, that makes you think, is everything okay in China? Because often you have to kind of read between the lines with Chinese economic activity and look at demand for things like copper, oil, And if energy requirements are lower, then that makes you think, well, that can't be good. So I'm worried about what this signals more broadly. But it's not just China. Europe is still a big demand driver for oil, and economic activity in Europe has been weak.
And on the supply side, OPEC's been trying and failing to boost the price of oil. It extended its supply cuts numerous times. But does this just sort of show that OPEC's power over the oil market has waned significantly? There are other big producers, not least the United States.
Yeah, that's one of the big political shifts that we've seen. OPEC is now, I wouldn't say irrelevant, but it's much less important than it was. They don't really seem to be able to do what their primary job is, which is to control supply of oil and affect its price. And that's due to political fragmentation amongst the members and the fact that more of the oil is now produced by non-OPEC members, the US being most important there.
So we've talked about 3 assets that are on the naughty list, and they're all kind of driven by macro factors: the US dollar, Japanese bonds, and oil. After the break, let's look at stock markets.
Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Trading 212 Stocks and Shares ISA is the cheapest way to invest, with zero commission and one of the lowest FX fees I could find on the market. Looking to keep things simple, you can easily automate your investing with pies that allow you to rebalance your portfolio at the click of a button. Customers with Invest accounts can also benefit from the Trading 212 card, which has no FX fees, true interbank rates, and offers 1.5% cashback on all transactions up to £15 per month. Many Happy Returns listeners can claim free fractional shares worth up to £100. Just create and verify a Trading 212 Invest or Stocks ISA account, make a minimum deposit of £1, and use the promo code RAMIN, RAMIN, within 10 days of signing up, or use the link in the show notes. When investing, your capital is at risk and you may get back less than invested. Past performance doesn't guarantee future results. Pies and Autoinvest is an execution-only service, not investment advice or portfolio management. Automatic investing refers to executing scheduled deposits. You are responsible for all investment and rebalancing decisions. Free shares can be fractional. 212 cards are issued by Paynetics, which provide all payment services. Trading 212 provides customer support and user interface. Terms and fees apply.
Okay, so when we look at the global stock market in 2025, if you had to pick one country to go on the naughty list, who are you going to point the finger at?
In terms of crushing millions of people's hopes, I'd say it's probably the Indian stock market. So I do have quite a few Indian clients who I speak to one-to-one, and some of them, not all of them, are quite keen on their domestic market. And remember that India has really competed with the United States as being the most expensive market globally. I think that's part of the structure of their market, which is that they have loads of domestic investors who now have these accounts where they can regularly save into mutual funds, which buy domestic stocks. So that tends to keep prices pinned at high levels. But if you look at valuation graphs for emerging markets, India is just way out there. So it's got a forward price to earnings multiple of over 22 times forward earnings. Compare that with almost any other EM country, and it's far higher. China's still at under 13 times forward earnings.
And the Indian stock market has had a bad year. There's an article in the FT recently with the headline, "Indian equities underperform peers by widest margin in 3 decades." So if you looked at the MSCI India Index, which is more or less flat in dollar terms this year, that compares with MSCI Emerging Markets, which in aggregate are up more than 25% for the year. So it's India's weakest relative performance since 1993.
And from a UK perspective or an American perspective, if you bought into that Indian stock market rally, you'd have been even more disappointed. And that's primarily because of the currency effect. So, for example, if you look at the Indian rupee versus the British pound, on average, since 2019, it's been falling by about 5% per year, fairly steadily. And that's going to be a huge erosion of your capital gains. And over the course of this year, of course, it's just been bouncing around in a range. So primarily what you'll see is that devaluation.
I read a Reuters article this morning, actually, which showed that the Indian rupee has fallen to a record low. And this is amid the sort of US-India trade negotiations, which seem to be pretty stalled right now. But the rupee has declined nearly 6% against the dollar year to date. And remember, the dollar's had a bad year, but the rupee is doing a lot worse. And this has caused foreign investors to pull back from the Indian market. You mentioned how important domestic Indian investors are, but no market can survive without foreign capital. And Reuters says that overseas investors have sold more than $18 billion worth net of Indian equity in 2025, making India probably the worst market in terms of capital outflows. Is this just people reacting to valuation? Because it has had a fantastic few years building up to 2025.
It's a difficult one because I think the structural story, the long-term investment thesis, is a strong one. You've got a country which is huge. It's got incredible natural resources, primarily its people, and they're becoming much better educated. There's a very rapidly growing middle class. If they manage to improve things like infrastructure, they could be looking at the kind of growth story that we saw in China. So lots of things which could drive growth long term for the equity market. But, and here's the big but, I think politically they have to make some choices. Will they carry on being very closely related to Russia, or will they choose to align more closely with the West? Because it's really easy and cheap to buy that Russian oil. And if you're a rapidly growing country, that's a real important choice because India depends heavily on those oil imports. So I think politically there are some problems here. And of course, you've got the valuation problem shorter term. So I think if there was a big crash in equity markets globally and in Indian equity, I definitely think about buying some.
It's interesting you made the comparison to China, because the Chinese stock market's had a very good year. The MSCI China index is up something like 30% over the last 12 months. But then that's coming off the back of a few really disappointing years for China. So it's kind of flipped. And I saw one analyst say that the golden rule of emerging markets is that India and China can never rally together. What do you think about that?
Yeah, that's true, actually. Because if you look at the beginning of the year, China was the uninvestable market where people just wouldn't have even considered buying it. And valuations were crazily low. And India was incredibly expensive. It was pushing multiples which were similar to the US. So that was a very different risk reward starting the year. And it's pretty much come to fruition, which is that China's outperformed India massively.
But this kind of to and fro between India and Chinese equity, is that just a coincidence? Or is there really a kind of competition for capital between the two markets so they can't rally at the same time?
I think at this point there isn't that competition in capital. China doesn't really depend on foreign investors for a lot of its capital spending. At least not at the moment. Whereas I think India does depend on that more.
I mean, I think the real story is what you said, that India was overpriced. At least it looked that way on paper. So the big underlying trend for Indian stocks this year has been a dramatic cut in earnings forecasts for 2026. So over the course of this year, analysts have cut their earnings forecasts for Indian stocks by more than 10%.
So if the price of the stock is a combination of the price to earnings multiple and the forecast earnings, well, re-rating the amount of euphoria pumping up the price can only do so much. And if people are downgrading the forecast earnings, that's going to take some of the euphoria out of the market as well. So I think it's just the case that, they were on this stratospheric climb and I think they just ran out of fuel, which is the earnings growth.
A temporary pullback though, or a structural shift?
Yeah, I'm worried about the earnings. I think if those don't get their mojo back, well, that's not going to relight the jet engine and will probably be in a bit of a fall for some time.
But there's definitely been a shift in narrative, I think, around the Indian stock market. And if we're talking about shifts in narrative, asset number 5 on the naughty list has had probably a greater turnaround to the downside in terms of the story it's telling than anything else on this list. So going into 2025, Europe's most valuable listed firm was Novo Nordisk, a Danish pharmaceutical giant. But its share price has plunged more than 50% so far this year.
Now, Novo was obviously one of the huge beneficiaries of these new class of drugs, which help regulate blood sugar. So here we're talking about glucagon-like peptide 1 or GLP-1.
You know, you've been periodically telling me how well your weight loss journey is going. Have you tapped in to these new drugs, or have you been doing the old school way?
No, I went the old school route. I just ate less.
All right, Grandad. Talking about Novo, what's the story here? Why has it had such a disastrous year? I think the first thing to say is that obesity drugs market is highly competitive right now. And Eli Lilly seems to be winning that battle, at least in the US.
Yep, if you were overweight, Novo Nordisk, it would have been a very painful year. So I think it had a 20 to 25% one-day sell-off, where almost all of the euphoria came out of the per share price in one day. That's pretty unusual. And can you imagine the pain?
But that was on the back of disappointing clinical trials, wasn't it?
So they were hoping that there was going to be a way of treating Alzheimer's. So maybe semaglutide would slow cognitive decline. And they had a drug trial called Evoke Plus, where they were testing that. And anyway, the result of those trials suggested that actually that wasn't the case. So that was clearly a disappointment for them and investors when they discovered that.
It seems to be that they're throwing this new class of drugs at any sort of long-term disease and hoping it will show it's a magic cure. It seems to work for obesity, right, with some side effects. But no, it's not going to tackle dementia. But it's had other problems. It's issued profit warnings. It's changed CEO. And really, it's completely unwound the recent year's success story, where it had this huge rally based on the fact we've got a treatment for obesity, an effective treatment. And if you look at its share price, it's gone from around 300 krona in 2022 up to a peak of more than 1,000 last year. And now it's crashed back down to 300 again. So is this a value stock now? What was a growth story? Should contrarian investors be looking at going, I could buy this innovative company on the cheap?
Well, if we look at the multiples, at the moment, it's roughly at 14 times forward earnings. And if we compare that with its history, it's well below the recent crazy levels. And it's 10% below the broad category of MSCI pharmaceutical companies. So relatively cheap, assuming those forward earnings come to pass. But of course, that's based on expectations about their drug portfolio and what kind of revenues it's going to generate, which is a big unknown.
If you buy it today, it's the classic example of trying to catch a falling knife, isn't it?
I think so. And I think that euphoria, when it's gone, there can be a long period of purdah before we go back to people buying into the company. People remember getting burnt, and they remember it for a long time.
It's really interesting, isn't it, that over the last few years, one of the big narratives has been these anti-obesity drugs. It's been a bit dwarfed by the AI narrative, but it has been there bubbling under the surface. But this was one of the big stars of it. It rose to become Europe's biggest company. Now it's a long way from that. Are there any lessons here for the AI trade?
Yeah, I think the country concentration is one of them. If you see one of these structural shifts in behavior, the problem is always that you're going to get overcapacity and too much euphoria built into the share price. And of course, we see that for AI right now. At a certain point, you have to move from euphoria and high expectations to show me the money. And that really didn't pan out for Novo Nordisk. And I think for many of the AI companies, it won't pan out either. There's going to be consolidation in the sector. A lot of the competing algorithms are going to come to the fore or fall by the wayside. And that's why I think investing in these kind of trends is always quite risky.
But the Magnificent Seven are not on the naughty step yet, maybe next year. But interestingly, the next thing on the naughty list is cryptocurrency. Now, we've said in the past how cryptocurrency, and Bitcoin specifically, is very highly correlated to US tech stocks, i.e. the NASDAQ index. But has that correlation changed a little bit? So there's been a big sell-off in Bitcoin, whereas US equity markets are near all-time highs still.
Yeah, I've been using this as a kind of wonky valuation measure for cryptocurrency. So what I do is I look at an index which is composed of 3 times daily NASDAQ, and I compare that with Bitcoin. Now, when that's at the bottom of the range, when Bitcoin has been trading much more weekly than NASDAQ, I take that as a kind of positive signal that Bitcoin is relatively cheap. I think the difficulty at the moment is that that's happened. But my worry is that that's not so much about Bitcoin being underpriced as the NASDAQ being overpriced.
I knew you were going to say that. I knew you were going to say that, Robin, coming into this section.
So I'm not piling into cryptocurrency. I did buy a little bit because they've now been issued in the form of ETNs. So I can just buy it as part of my ISA and it's just really easy.
UK regulators top-ticked the market. In fact, we did an episode, didn't we, where we said, yeah, they've improved Bitcoin ETNs in the UK. And we said, I bet that is going to be when the crypto crash comes. And it was.
So maybe we should put the FCA on the naughty step for that one.
That's a bold move for a finfluencer to try and put the FCA on the naughty step.
Financial educator, not finfluencer.
Okay, sorry. It's not QE. But anyway, going back to Bitcoin, it didn't look like it was going to be on the naughty step this year. So it started 2025 at around, $96,000. It rallied up, didn't it? Massively. New all-time highs, more than $120,000 per Bitcoin. And it reached a peak not even that long ago, back in October. But since then, it's crashed to below $90,000. Weirdly, at the same time that the US Congress has been passing all these crypto-friendly bills. Institutional adoption at the same time as a big sell-off.
Yeah, maybe people bought the rumour and then sold the fact. But I think it's more to do with people being concerned about risky assets and particularly about cryptocurrency. One of the really worrying signs was all these cryptocurrency treasury companies which were hoarding Bitcoin, where they could see their share price increase by 1,000-fold overnight by simply saying that that's what they were going to do. Companies which had absolutely nothing to do with finance overnight increased their multiples hugely. But it ended in the completely predictable way, which is we got a big correction in the cryptocurrency prices, and we saw some of these companies, the Bitcoin treasury companies, really get crushed.
Well, let's talk about the biggest of the Bitcoin treasury companies, which is Strategy, formerly called MicroStrategy. And it's never a good look when a company changes their name to jump on some trend.
Now, what was really weird about MicroStrategy was if you bought it as a proxy for Bitcoin, effectively you were paying a premium relative to the Bitcoin that it owned. Now, that premium, while it stays large, seems like an infinite money glitch because all they have to do is print more equity and they can just get more Bitcoin than it costs them to raise the capital. Now, as long as that premium is stable or rising, that's all great. But guess what happened? Well, that premium has gradually been eroded. It's not quite at unity yet, as far as I know, but it is getting close to it. So what was an infinite money glitch now just looks like a crazy strategy, which it always was, of course. I mean, a company shouldn't be hoarding cryptocurrency. It should just get on with providing the goods and services which it's supposed to.
But MicroStrategy owned 3% of all Bitcoin in circulation. It's a big whale here.
And people have been talking about excluding companies which own a lot of cryptocurrency as part of indices. So MSCI has certainly been thinking about excluding those companies.
Do you think they should be excluded from the index?
I think so, yeah, because it's really a company where the value is being hugely inflated, not because it's good at providing goods and services, but because it's chosen this strategy which is based very much on euphoria, a craze for a particular asset, which inevitably is going to implode at some point.
But these are meant to be passive indices, just tracking the market, right? The market is saying at some point, these companies are worth that much money. Why would you just say, okay, I don't like your strategy, you're not in the index?
I think that thinking that passive funds are anything like passive is a misunderstanding of how they work. I think it's an awful name for the index approach. Usually they've got very selective filters as to what companies can be included. I mean, some of those are obvious, like country or currency, but there are other things like profitability, other things like corporate governance, liquidity. So it's by no means just mindlessly buying everything. No, that's not the case. And this is just one more criterion for quality, I think, which ensures that what you're buying is not something which is puffed up for no reason.
Where do you draw the line, though? You're going to kick Tesla out of the index? That has got some cryptocurrency on its balance sheet. That's trading at crazy multiples.
I wouldn't do it based on multiples necessarily, because if people love the company, that's probably a good thing. But I'd be worried about things where something or some aspect of governance seems to be out of control, which is what I'd say is happening with these treasury companies, these Bitcoin treasury companies.
As we know, Tesla has great governance. That board of directors is Elon Musk and his close associates. But do you know what I mean? Like, once you go down this route of saying, we don't like your business plan, we don't like how you structured your company, then I think it's so hard to draw that line.
Well, with governance, that's effectively what you're doing. You're saying these are practices which are acceptable and these are ones which aren't.
Giving Elon Musk a $1 trillion pay deal, acceptable. Buying a load of Bitcoin, not acceptable. I don't know. I'm being devil's advocate. I kind of get what you mean. Like, I don't want to own MicroStrategy as part of the index. And presumably, if it gets cut from the indices, that will have a big impact on its share price and maybe the Bitcoin price. But it has been a relentless rise for MicroStrategy. So its shares rose more than 1,200% since it first bought Bitcoin in 2020. But it's now seen a plunge of around 60% since its peak. And the short sellers, of which there were many, have been quids in, haven't they? One of the most prominent ones, Jim Chanos, did a clever trade where he went long Bitcoin and short strategy. So he was basically insensitive to the price action of Bitcoin itself and was just betting on the premium that strategy had for its own Bitcoin shrinking. And that's paid off. And I think he's now closed that position.
Yeah, that was a smart trade. I thought that was inevitable as well, that premium would shrink, particularly as more institutional investors started to adopt buying Bitcoin.
But Bitcoin is volatile, right? It has good years, it has bad years, it has long drawdowns and crypto winters, and then it bounces to new all-time highs. I can't see anything to say Bitcoin's now in structural decline. Sure, the Bitcoin treasury companies might get eradicated if we have a long drawdown.
But I think what attracts people to Bitcoin are the incredible returns which we've had historically. And what people forget is that if the volatility's fallen, it's now around 30%, I think, maybe a bit higher at the moment from where it was, which was over 100%. Well, lower risk means lower return. There isn't a free lunch in finance. You're not going to have an asset generating 1,000% returns with a volatility which is just a bit more than an equity index. That just doesn't happen. So I think that the major attraction for Bitcoin is going to go away, which is the incredible returns. And all of those people that flock to it as a Hail Mary pass are no longer going to be attracted to it, which may make interest in it fade as an investment.
Now, talking of volatility, if you're a bit bored by Bitcoins, low volatility now, and even MicroStrategy, you could have bought a 3 times levered long MicroStrategy fund. Now, there you are going for a volatile asset, and year to date it's down 96.6%.
So this is what you'd call leverage squared. You've got a leverage investment on MicroStrategy, which is a leveraged investment on Bitcoin, which is itself a very volatile asset class. So this was never going to end well.
But talking about speculation and 3 times leverage, let's talk about the property market, because here people buy with 10 times leverage. You put down a 10% deposit to buy a house. Now, I live in London, and I know people trying to sell houses around here. And it's not that easy right now. I would say the 7th asset on our naughty list is London property.
And in the UK, what we've seen generally, if you look across the country, is that regions which had the highest price to earnings multiples are the ones which have sold off the most, with London being the really standout example. So in the year to September, I see that the average house prices have fallen by an annual rate of 1.8%. And if you look at regions of London, so for example, the City of London, that's down 15%, Kensington and Chelsea down 11%. So very painful for people in those places.
Yeah, the prime property market has really had the rug pulled from under it. So partly that's because rates are higher. But a big part, I think, was the uncertainty around the budget and the changes to the non-dom tax rules. Saw a lot of people leave London, I think, and list their properties for sale. And prices have suffered, as you'd expect. There was a good article in the FT where it looked at London versus the rest of the country. And if you look at regions of England, London is the only one that's fallen this year.
So that is pretty much a reduction of the price to earnings multiple. So it is, again, a removal of euphoria.
And the other thing bubbling away here is that flats, apartments have suffered more than houses, I think. There's several reasons for that. People are scared by the service charges, which have been going up rapidly in recent years. There's obviously the fallout still from the Grenfell Tower disaster, and there's lots of building works going on to replace cladding all over the place. And also a lot of these sort of 1-bed, 2-bed flats are bought by people as first-time buyers. And that bit of the market, I think, has suffered as they're more exposed to interest rate changes.
And I always try to get people to think in real terms, where you inflation adjust prices. And if we look at that in the UK, even though in nominal terms prices have been rising over the last year for the UK in aggregate, in real terms they're down about 15% since their peaks. And over the long term, they haven't moved for 20 years.
So I think we've made it to the end of the naughty list, almost. There's one thing, Romin, which is on the naughty list every year, and we mustn't forget it. That's active funds.
Now, we're going to put this on the naughty list, even though we don't have the latest data. So the latest data we can see is for the middle of the year in 2025. But because it's looking at 10-year performance, then I doubt this will change much at all. But if you look at a map of the world, and the S&P Index versus Active report does this, they have a map of the world which shows over 5, 3, 1-year periods, sometimes even 10-year periods, what percentage of funds were beaten by their passive benchmark. The numbers are absolutely staggeringly appalling, and that stayed the case for a very long period of time. So let's look at the US, for example. It's the biggest market. Over a 5-year period, active managers have been beaten by their benchmark, the S&P 500, in 87% of cases. And the longer the horizon you look at, the worse the underperformance is.
And US isn't the worst market. In Europe, over a 5-year horizon, 92% of active managers have underperformed. So I think we're safe in putting them on the naughty list. But maybe we'll owe them an apology in the new year. We'll see.
If you want to sidestep some of the assets on this naughty list, or perhaps have a strategy which doesn't depend on finding them, then consider joining our community. To do that, you can go to our website, pensioncraft.com/membership to learn more.
Okay, today's dumb question of the week. Is any asset immune to interest rates?
Well, I'd say the obvious answer in one word is no. There's no asset which really isn't affected in any way whatsoever by interest rates, because interest rates tell you about the time value of money. So even if you're just thinking in terms of opportunity cost, you'll always be thinking, well, I'd have been better off parking the money in this or that fixed income investment.
So let's approach this from the other way then. What assets are most affected by interest rates?
Well, let's take a UK government bond, which is the longest dated one, which is TR73. So this is a gilt which is going to mature in 2073. Now, I'm going to be 105 when that bond matures, and it's exquisitely sensitive to interest rates because of its huge duration, which is just under 27 years. So that means if interest rates increase by 1%, the price of this thing will fall by 27%. So that's pretty sensitive. So I'd say that's way out on the spectrum in terms of interest rate sensitivity.
But at the other end of the spectrum, let's say we reduce duration to effectively zero with cash. Doesn't mean it's insensitive to interest rates. It just likes higher interest rates, right? It'll pick up the higher interest rates quickly.
Yeah, if you think about the value of that investment, its gradient, the rate at which it increases, is directly proportional to whatever SONIA is or whatever the sterling overnight index average is.
And if we move away from bonds, other risky assets like stocks, real estate, they tend to prefer lower interest rates. They're certainly not in any way immune to interest rates.
Yeah, particularly growth stocks, where people say that they have a long duration. I think that's misleading, but that's what people say. So here we're thinking about companies which probably have borrowed a lot in order to grow. So their income will be affected by how much they're paying to service their debt. So clearly those are interest rate sensitive, very interest rate sensitive, if they've got a lot of leverage.
But even the other side of equities, when you're looking at more of the value stocks, the boring defensive, like utilities companies, people sometimes compare those to bonds, don't they, and say they're bond-like. They're still sensitive to interest rates. They pay high dividends often, which don't like high interest rates. And maybe they're competing for capital alongside bonds.
Yeah, like you say, I think it's more of a kind of competing for capital thing there. If I can earn 6% with a gilt, I'm not going to park it in equity, which is much more volatile.
But surely, in the world of finance and all the magical products they can concoct, can they not hedge out interest rate risk? Come on.
Yes, but I know where this is leading. I mean, there are strategies called liability-driven investing, where you invest in anything you like, and then you overlay it with swaps, which are these interest rate derivatives which can cancel out the overall interest rate sensitivity. So let's say you've got a 5-year fixed rate gilt. So you own that. That means you're receiving fixed income payments. But if you pay away those fixed income payments and receive floating on a swap, well, that effectively cancels out the interest rate sensitivity.
Job's a good one.
Well, not quite, because if you remember what happened during the Trust mini budget, it was those strategies which blew up. And that's because of margin calls on the swaps. Because people price in a certain amount of volatility into the assumptions when they enter into the swap. But of course, the intraday fluctuations we saw in yields during that period was so large that effectively companies, I think, had to unwind some of the swaps or post so much margin that they simply hadn't got enough cash to pay up. So I think, there are limitations. But yeah, financial engineering to a certain extent can create portfolios which overall are interest rate insensitive.
And I have seen people say that there are very niche asset classes which are pretty close to interest rate insensitive because their primary risk factors are nothing to do with macro. So it might be things like catastrophe bonds where hurricanes don't really correlate to interest rates. They do their own thing. Or maybe things like litigation finance where who's going to win a lawsuit is, again, not really related to interest rates.
I'd say indirectly there still are relationships there because of the price of capital. If you're comparing it with a gilt, say, and you're thinking about risk-adjusted return, well, you'll still be comparing it with something which is interest rate sensitive, even if on the face of it, the investment itself isn't.
So really what we're saying is you can't run away from interest rates. You've just got to know how they affect your portfolio.
And that's why it's part of the holy trinity of macroeconomic investors. You've got rates, that's probably the most important, inflation and growth. Those are the three everyone looks at.
Thank you for joining us for Many Happy Returns. Keep sending us your questions, no matter how dumb, at mhr@pensioncraft.com.
And do remember to check out pensioncraft.com for all the information about our membership, courses and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Robin Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.